about taxation. So the primary source of federal taxes are going to be individual income taxes, payroll taxes, and the payroll taxes are the ones that finance the Social Security, Medicare. Um, and then we also have corporate income taxes and then social insurance taxes. So basically, what the government's trying to do, right, is they need the money in order to spend it on public goods, national defense, things that we talked about last section. So these are the different sources that we have here. So as you can see here, a lot of the tax revenue comes from the income tax. So basically how much money you made from working, right? The government's going to take a portion of that as tax. Okay? And so as you can see here, this changes per year, mainly because your income changes per year, or maybe the country's income changes. Payroll taxes, so things like Social Security, those are the things that you pay into now in order to collect it when you retire. Same thing with Medicare, right? You pay into it to where when you're older and you are retired and you need health insurance, you paid into it, you can collect it now. So those are the payroll taxes. Corporate income taxes, so basically corporations do have an income, so they will be taxed on that. It's a very low percentage in terms of GDP though, which is pretty interesting. And then we have excise taxes. Excise taxes are just things like a sales tax, things like that. So individual income tax, tax based off your income, all forms of income received by an individual. So you know, if you're mowing someone's lawn and you got $50, that $50 is your income. So you could report that to the federal government, and then you would have to pay taxes off of $50, which most of the time would be nothing. But you know, that is the idea: is that whatever income you get, that is subject to tax. Payroll tax, we talked about those, and then in the U.S., we have what is called a progressive tax. So progressive means you go forward, right? So if what happens here is a tax that collects a greater share of the income from those with higher incomes than those with lower incomes. Okay? So what we're trying to say here with progressive taxes is that we have marginal tax rates. Marginal meaning change. Okay? So we have different tax rates. We have a change in the tax rates based off of your income. All right? So for example, if you made $0 to $9,000 income, you would pay taxes of 10%. But if your income is higher, you have to pay a higher tax rate. You have to pay 25% taxes. So how this works is if you paid, or if you made an income of $9,075, then you would have to pay $907.50 in terms of taxes. If you made an income of $36,900, oh wait, actually, if you made an income of $36,900, then you pay 15%, which is equal to which is 5535. And then if you made an income of just one more dollar, so let's say 36,901, you now have to pay 25% tax. So now let's look at the difference there. So 36,901 times 40%. So now you pay 9,225.25. Okay. So just that $1, right, changed your tax bracket to where now you have to pay an extra almost $4,000. Just that $1 put you in another tax bracket, so now you have to pay a higher tax rate. But that's how it goes. Okay, that is progressive taxes. Progressive. Meaning, if your income is higher, your tax rates are higher. We also have things like a proportional tax, which is basically all incomes pay the same amount. So instead of it going 10, 15, 25, it's 15, 15, 15. Okay? So that's proportional. Everybody pays the same amount. And then there's regressive, where if your income is higher, you actually pay a lower tax. So it would go 25, 15, 10, right? So basically these are progressive. Regressive would be here. So let's go regressive in blue. So this would be 25, 15, and 10. The higher income you have, the lower taxes you pay. Now, a sales tax is a regressive tax. And you're probably thinking, well, isn't the tax all 8.25% in Texas, right? Isn't the sales tax just the same for everybody that tries to buy things? And that is true. However, because we're dealing with income, okay, this makes sales tax a regressive tax. I'll show you how. So basically, if we made $100,000, okay, and we go out and buy some t-shirts and stuff like that, let's say we spend $10,000. Okay, we're going to pay the sales tax. All right, which let's just make it simple at 8%. So this means you spend $800 in tax. Now, since this is a regressive, is an income tax, right? What we're going to do is we're saying, okay, you're spending $800 and your income's $100,000. So for you, your income tax rate based off of this, right, would be 800 divided by 100K. So basically, because you make $100,000 and then you're spending $800 in sales tax, your tax rate is 0.8%. But let's take somebody who is making $50,000. Okay, and they go out and they're spending, let's say, $5,000 on stuff. Okay, so therefore they have a tax rate, sales tax, 8%. Same amount, right? Same 8%. But now they're spending 400. So now we'll do 400 divided by 50,000. Okay. Whoop. All right, hold on. Let's start over. So you're spending 50,000. Let's say you spend $10,000, same amount of tax. So therefore, you're going to spend $800 in sales tax. But because of your income being $50,000, your tax rate would be $800 divided by 50,000. So therefore, your tax rate would be 1.6%. Okay, so what we saw here is when you made more money, you actually paid a lower tax. And when you had less money, you're actually paying more tax. So that's why sales tax is a regressive tax, just so you know. You don't need to focus on the math side of this, but you do need to realize that what a regressive tax is. We also have corporate income tax, the tax imposed on corporate profits. An excise tax is things that are imposed on things like gasoline, tobacco, alcohol. Basically, it's just like an extra tax on these things. Most of the time, it's because of negative externalities, such as gasoline causes pollution. So therefore, we're going to put an excise tax on these things. And then we have a state and gift tax. So a tax on people who pass assets on to the next generation, either after death or during life in the form of gifts. So if you got a $5,000 gift in terms of money from your parents, right, that is subject to tax. So that's a gift tax. We also have state taxes. So, these are the ways that the state and local governments can collect money in order to do their spending, because they have to do things as well, such as local parks, local schools, right? So they have to do spending as well, so they need money. And they'll do it through sales tax, property taxes, revenue gotten from the government. or any personal corporate income taxes, and a variety of fees. So basically, the states and locals have different rules in terms of tax. So, for example, Texas does not have a state income tax. You do have to pay the federal income tax, but you don't have to pay federal and state. But Texas does have a higher sales tax than Florida, right? So basically, the tax rates could change per state. Income tax rates could change per state. So they all have their different ways of collecting taxes. All right. So in the next section, we'll talk about the impact of the federal deficit and the national debt. I'll see you there.